let's talk about something that honestly I'm shocked more people aren't talking about. Because while retail has been chasing memes and arguing about when Bitcoin will hit $200,000, there is this quiet behind the scenes revolution happening in decentralized finance. And here's the crazy part. It's not happening inside crypto, it's happening because of crypto. Let me put it like this. Imagine waking up one day and realizing the entire financial system is slowly moving onto the blockchain, but nobody told you. Like one of those "wait, when did that happen" moments. Well, the beginning of that is currently happening behind the scenes right now with RWAs, real world assets. You've got BlackRock, Franklin Templeton, JP Morgan, the biggest players in traditional finance, quietly tokenizing real-world assets, moving billions on-chain, and reducing settlement times from days to minutes, all while retail is still arguing about dog coins. So in this video, we're pulling back the curtain because RWAs are not coming someday, RWAs are already here, and they're about to change everything from yield to lending to collateral to how money moves. So what the heck is an RWA? Before we get too deep, let's just keep it super simple. RWAs are basically a real world asset tokenized on a blockchain so you can buy and sell or use it 24/7. That's it. It's not magic, it's not sci-fi, it's literally just taking real assets like US Treasury bills, real estate, gold, corporate debt, private credit, and money market funds, and putting them on chain so that anyone can access them, move them, borrow against them, or invest in them without going through 15 middlemen and waiting 3 to 5 business days for money to settle. If you understand stocks, bonds, yield, or even just basic finance, RWAs make perfect sense. They're just the real economy on the blockchain. And not many people know about these, and that's exactly why we're doing this video, because retail doesn't know, but institutions do. Back in 2020, to combat the economic downturn, the Federal Reserve aggressively lowered its benchmark interest rate to a range of 0.25% to 0%. Crypto yields went crazy. DeFi farms were paying 50%, 80%, 200% APY. Everyone thought they were geniuses. Spoiler, it was not sustainable. Then 2022 hits, rates skyrocket, and suddenly real-world assets, borrowing things like treasury bills, are paying 5% yield safely. And institutions started asking, hold on, why are we still running a financial system on 50-year-old rails when crypto has faster, cheaper, and more transparent infrastructure? Fast forward to today. BlackRock tokenized treasuries. Franklin Templeton moved money market funds on-chain. JP Morgan is running repo markets using its own blockchain. MakerDAO is holding billions in real-world credit. DeFi protocols started buying T-bills. Commodity-backed tokens like gold are taking off. This isn't hype, this is quiet adoption. The kind that happens before the headlines, the kind where rich people can change the rules quietly and the rest of the world finds out later on CNBC. Let me put it this way. If the last 10 years of crypto were about speculation and adoption, the next 10 years are going to be about integration. Crypto and traditional finance are merging, not replacing each other. And RWAs are the glue. All right, now let's break this down into normal people language. Tokenization. This is when you take a real asset, a T-bill, a piece of real estate, a gold bar, a business loan, and you lock it into a custodian, trust, or regulated entity. Then you mint digital tokens that represent ownership of that asset. Think of it like you're buying the digital wrapper around the real thing. Why put it on chain? Well, because you unlock all things that traditional finance cannot do efficiently. 24/7 trading, instant settlement, no paperwork, no middleman fees, global access, fractional ownership, and transparency. Institutions love this, and here's why. They save millions in operational cost. They reduce counterparty risk, they can settle repo trades instantly, they can run money market funds on-chain, and they can get real-time audits. This is not a bunch of crypto nerds writing crypto code in a basement, this is Wall Street using Ethereum. And retail loves it too. This is where it gets exciting for beginners in crypto. You can now access financial products that were previously locked behind wealth gates. Private credit used to require $100,000 minimum, with crypto, $50. Money market funds used to require brokerage accounts, now just a wallet. Real estate used to need a mortgage, now fractional tokens. RWAs make access available to everyone. Now things that used to be only for the rich, like renting out properties, funding private loans, or earning yield from corporate credit, are becoming accessible to normal people for the first time. But they also raise safety questions, which we'll go over later in this video. Let's get into the real stuff now. Franklin Templeton's on-chain money market fund, BENJI. Yes, that Franklin Templeton, a real multi-billion-dollar US asset manager. They built the first regulated money market fund fully on-chain. The tokens represent your shares, the assets are short-term US treasuries, and the chain that they use is Stellar and Polygon. The thing has over $350 million, and this is happening right now. There's BlackRock's tokenized treasuries, BUIDL is a ticker. BlackRock, the biggest asset manager on the planet, said, yeah, let's tokenize US treasuries on Ethereum. Instant settlement, on-chain collateral, programmable compliance. This is BlackRock, not some random startup. How about JP Morgan's Onyx blockchain? JP Morgan runs an internal blockchain division called Onyx. They do repo transactions, billions of dollars, with instant settlement. This used to take hours, now it takes seconds. They're not doing this for fun, they're doing it to reinvent the plumbing of the financial system using the blockchain. And MakerDAO's RWA vaults, this is billions in real world credit. Okay, so this one is big because it connects DeFi and traditional finance directly. MakerDAO, the protocol behind DAI, a popular stablecoin, started putting real US treasuries and real-world credit inside their collateral system. Not imaginary crypto yield, not meme coin, liquidity pools, we're talking actual short-term government debt backing a DeFi stablecoin. MakerDAO now holds multiple billions in real-world assets. This is a DAO, not a hedge fund, managing a massive portfolio of traditional financial instruments. For those who don't know what a DAO is, it's a decentralized autonomous organization. It's basically an online blockchain-based community that runs like an organization without a CEO or traditional management team. The rules are built into smart contracts, decisions are voted on by token holders, and the entire system operates transparently on-chain. It's for the people, by the people, literally. So a DAO is basically an organization run by code and community votes instead of bosses. Everything is transparent, automated, and governed on the blockchain. And why does this matter with MakerDAO? Because it proves the point that DeFi doesn't have to rely on unsustainable APYs anymore. It can plug into real yield from the actual economy. That's a massive shift. RWAs are bringing real yield into crypto instead of magic internet yield. Alright, this is where it gets interesting because this used to be a rich people only market. Private credit is one of the biggest financial markets in the world. We're talking about business loans, invoices, factoring, small and medium-sized enterprise financing, short-term credit. Normally you need $100,000 plus minimum. You need accredited investor status, and you need to know a guy who knows a guy. But with tokenization, suddenly the average person can buy tiny fractions of these assets safely, transparently, and globally. There are platforms like Maple Finance with institutional loans. Centrifuge has tokenized business financing, and Goldfinch has global credit pools. They're all letting people invest $10, $50, $100 at a time into what used to be a multi-million-dollar playground. And yes, institutions are using these too, because tokenized private credit gives higher yields, faster settlement, transparent performance, global liquidity, and 24/7 access. This is the part of RWAs where retail goes, wait, we're allowed to do this too now? Yes, with safety considerations, which we'll cover later. And tokenized commodities like gold on-chain is another example. So two massive examples is Paxos Gold, PAXG, and Tether Gold, XAUT. These are tokens based one-to-one by real gold stored in real vaults. You literally own gold without storage, shipping, insurance, paperwork, delays. If you want to send $10,000 worth of gold to someone across the world, boom, one blockchain transaction. Now we get to the fun part, how institutions and everyday traders will actually use RWAs in the real world. Starting with institutions, they have faster settlement, that's the big one for them. Wall Street runs on slow ancient rails. ACH, Swift clearinghouses, all built decades ago. On-chain RWAs reduce settlement from 2 to 3 days to minutes. 24-hour wire windows, 24/7 movement. Multi-step compliance. How about programmable compliance? JP Morgan literally built a blockchain to fix their own settlement problems. So that's saying something. There's also collateral efficiency. Institutions care about collateral more than returns. Collateral keeps the system running. Tokenized assets can be redeployed instantly, used across multiple platforms, verified publicly, and audited in real time. Institutions love that. And of course, lower operational cost. Everything is cheaper, there's no custodian paperwork, no delays, no human errors. This is why BlackRock is interested, it saves them millions. And is also great for serving global clients instantly. RWAs let them reach clients anywhere in the world without needing 20 middlemen to approve a transfer. Now let's talk about retail use cases, how you could use RWAs. First is safer yield instead of DeFi roulette. RWAs let retail access treasury yields, corporate credit, private lending, and commodity-based tokens safely. No more 10,000 APY nonsense, just real yield from real assets. There's fractional ownership. Want to invest $25 in commercial real estate, gold, money market funds, SME credit, T-bills? Well, you can with the blockchain and with RWAs. And there's also using RWAs as collateral. This is big. You can eventually use tokenized T-bills, tokenized gold, tokenized credit as collateral for borrowing, leverage positions, stablecoin minting, and yield farming safely and transparently. This will completely replace the shady collateral system of old DeFi, and it gives retail access to markets never open to them before. RWAs break down the walls that kept normal people out. Private credit, institutional grade bonds, true global commodities, and exclusive funds. For the first time, accredited-only markets are being broken open. This is a 24/7 borderless instant financial market. No banking hours, no wiring delays, no, your transfer will clear in 72 hours. We're entering a world where the financial system works like the internet. Instant, global, and unstoppable. Now let's slow down for a second because RWAs are incredible, but, and you knew the but was coming, we need to talk about the risks. RWAs are the future, but we don't just blindly jump into anything just because it's shiny and new. We stay educated, we stay protected, and we stay ahead. So here are the 6 biggest RWA safety points you need to understand before touching any of this. Starting with custodian risk, which is the big one. When you buy a tokenized T-bill, gold token, or private credit token, the real asset is held by some kind of custodian. That custodian must be legit, regulated, audited, and transparent. Because if the custodian blows up or doesn't have what they say they had, the token backing gets messy and you can lose money. For example, PaxG backs physical gold stored in Brink's vaults. That's legit. But random gold tokens from a startup, that's how people get burned. Safety point number 2 is regulatory risk. The rules for RWAs, it's being built while you watch this video. It's still happening. We have SEC involvement, CFTC involvement, bank regulators, global compliance layers, and country-by-country rules. This is not the Wild West of crypto anymore. This is regulated like crazy. And this matters because the line between security and token can shift quickly. But here's the truth. Regulation is coming because big money wants it, not because retail wants in. And when BlackRock and JP Morgan want something, it gets regulated properly. Safety point number 3 is smart contract risk. Tokenization does not equal indestructible. There is still code can have bugs, and even audited projects can have vulnerabilities. But the difference compared to old DeFi, RWAs are backed by real assets. There's something real behind the token. Still, never invest in any RWA project with weak contracts or zero audits. Safety point number 4 is liquidity risk. This one surprises people. Just because an asset is tokenized doesn't mean it's liquid. Some of these markets are tiny, some have thin order books, some depend on small numbers of buyers. Illiquidity doesn't mean bad, but it means you need to understand what you're buying. Safety point number 5 is pricing transparency. Certain RWAs, especially private credit, are not marked to market daily, meaning the prices don't update every second like crypto. Some assets are naturally slower to price. And this is normal, but traders need to know this upfront so they're not confused when charts aren't moving every 10 seconds. Safety point number 6 is platform risk. Simple rule. Real brands equal real safety, random startups equal extra caution. Tokenized BlackRock treasuries, very different from Bob's tokenized real estate experiment. Stick to BlackRock, Franklin Templeton, Maple, Centrifuge, Paxos, MakerDAO, proven established players. The safest RWA markets are the ones already regulated, audited, and used by institutions. All right, let me tell you the story here real quick. There's a moment in every financial shift where the people who understand what's happening early, they set themselves up for the next decade of opportunity. And RWAs are having that moment. Think about it. Crypto started with Bitcoin, a digital currency, then Ethereum, programmable money, then DeFi, financial tools with banks, then NFTs, digital ownership, then stablecoins with digital dollars, and then ETFs brought traditional finance money into crypto. And now RWAs bring the real world onto the blockchain. That was always the missing bridge. This is how crypto becomes part of everyday finance. This is how the system upgrades. And here's what nobody's saying loud enough. RWAs are not decentralized finance against traditional finance. RWAs are traditional finance moving into decentralized finance. The financial system is not ignoring crypto anymore. It's adopting it. It's integrating with it. It's rebuilding itself using the same technology that people in crypto have been using for years. That's why BlackRock is here. That's why Franklin Templeton is here. That's why JP Morgan is here. They're not chasing memes. They're not gambling. They're rebuilding the plumbing of global finance, and they're using blockchain rails to do it. So you're not late. You're not behind. You're not playing catch up. You're learning about RWAs at a time when most people don't even know that this exists. This is the ground floor of $1 trillion shift. In our crypto safety school, we are early again. We're teaching crypto safety, prediction markets, RWAs, macro trading, how tech, finance, and psychology all merge before the rest of the world catches up. Everyone else will talk about this in 2026 or 2027. We're talking about it now. That's the whole point of the Crypto Safety School, to prepare traders for the future, not just react to the past. So make sure to sign up for our Crypto Safety School. You get crypto alerts, crypto watch lists, whale trackers, news trackers, and crypto trading and safety classes and courses, and a weekly live stream. Because these are the conversations that will actually help you stay safe and get ahead, not the noise, not the hype, not the junk, but the future.